Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial Services. I'm Mark Bunting, the host of RCTV. Thank you very much for being with us today. We are talking all about gold and gold royalties. And if you have any questions for us, we are open to taking them. Put them in the comments section, please, on the right-hand side of your screen, and we'll get to as many as we can toward the end of our show. Now, as you likely know, our guest is a rather legendary miner in this country and globally, for that matter. He is David Garofalo, the chairman, president, and CEO at Gold Royalty. Let's bring him in here. Great to see you, David, again, and thanks for joining us today.
Good to see you, Mark. Thank you for having us on.
So let's start macro, and then we'll drill into the company that you run, Gold Royalty. Now, as we sit here, gold is up around, let's say, 34% or so in the last year or so. And we know that there are always a myriad of factors, different factors driving the price of gold. But what are the key factors as you see them right now, and what will sustain gold at elevated levels?
Well, I think it's the continued devaluation of fiat currencies. And that really has been a one-way trade for 50 years, Mark. If you go back to when we abandoned the gold standard in the early 1970s globally, gold's gone from $30 to $3,500, and the purchasing power of all the major Western currencies has declined by about 96, 97%. And that phenomenon is unlikely to reverse anytime soon, simply because there's been so much debt strapped on by all the governments in the Western world that they're going to have to devalue their way out of debt. There's no fiscally reasonable, responsible way for them to repay the debt.
And so, David, when you look at gold and you consider its prospects, are you always looking long term, at least 3 to 5 years out, and looking at the debt? It's unlikely, based on your comments, that global debt is going to go down, especially at the government level, and also that currencies are going to continue to lose purchasing power, which has happened historically, as you said. Is that how you look at it long term?
Yeah, gold's really not a commodity. It is a currency, and currencies trade relative to each other based on where interest rates are. And yes, the yield on gold is zero, always has been zero. But the reality is yield on sovereign debt is in negative territory because we all know that the headline inflation numbers understate the reality on the ground. So when you look at where nominal rates are, which are now declining again, inflation, I think, is reaccelerating. We're likely deep into negative territory. So it really does make gold an attractive asset class when you're looking to preserve the purchasing power of your currency, but also your savings and your capital.
It has been interesting the last couple of years or so as gold continues to hit all-time highs. We have seen a number of different things, and I'm wondering if they are changing at all in your eyes, such as a lack of inflows into ETFs, such as a real deep undervaluation for gold stocks. And also, we really haven't seen the generalist investors come into gold yet. But are you seeing some changes, some little green shoots, so to speak?
Oh, that's exactly the term I was going to use. We are seeing green shoots. I was just marketing through Europe a couple of months ago, and we are seeing some significant inflows into the specialty funds, the metal specialty funds, the gold funds. And as a result, we've seen an influx of new investors, institutional investors into our name. And I expect among our peers as well. We're not seeing that yet in the North American specialty funds. In fact, the only appreciation we've seen in those funds is due to capital appreciation, not due to inflows. And the phenomenon they're experiencing now, which really doesn't make a lot of intuitive sense, as the gold price appreciates, they're getting actually redemption notices from some of their unit holders, which doesn't make a lot of sense. So we're not seeing the generalist rotation in the North American equity markets that we should see. And if you look at the commodity appreciation, it's run ahead of the equities because the buyers of the commodity are different from the buyers of the equities. The commodity's been bought by the Far East, in particular the Chinese central bank, among others that are looking to diversify their central bank holdings into the one currency you can't print, the one that preserves value. We're not seeing the equity investors rotate out of the general equity market in the concentrated sectors where we've seen capital appreciation. For example, technology sectors, we haven't seen that rotation happen yet. It's inevitable given how stretched their valuations are, and I'm not sure what the catalyst will be, but we will start to see an influx, I imagine, in the short to medium term into the resource stocks, which hasn't happened to this point in North America.
Every time is different, David, as you know, and gold has some competition from the likes of Bitcoin right now. But based on your experience, when the generalist crowd does get involved, what triggers that usually? And will we see something repeat itself this time, or will it be different?
I think it'll be a correction in the equity markets beyond natural resources. So again, in those concentrated areas of the market where we've seen a significant amount of capital allocated, for example, the big 7 technology stocks, they've sucked up a lot of oxygen, as it were, in the general equity markets in North America. But those valuations are so severely stretched. There's deep value in the gold equities, in mining equities, in natural resource equities. Generally speaking, when you're looking at price to cash flow, price to earnings, they're dwarfed by where the technology sector is. Technology sector implies significant growth beyond what they're currently experiencing in earnings and cash flow, which we think is not sustainable. Though we're seeing that growth, obviously, in cash flow and earnings in the natural resource sector, given the significant appreciation we've seen in the underlying commodities. So it is deep value. And when we start to see that rotation, it'll be a significant and violent move upwards. It never is a kind of gradual move up, as you might expect. In the past, when we've seen equity valuations appreciate in the natural resource sector, it is quite a significant and upward violent move.
Now, speaking of growth, you're expecting a lot at Gold Royalty over the next 5 years. You've said annual compounded growth of something like 360%. You've also said that there are really 4 pillars of growth for the company. So can you run through those and maybe take us out to the end of the decade? And what does revenue look like? What will profit and margins look like?
Well, in 4 short years, we've gone from 18 royalties in our IPO back in March of 2021 to over 245 royalties within the portfolio. And as you can imagine, you can't just focus on one pillar of growth in order to achieve that. So as you correctly pointed out, we have 4 distinct pillars of growth that have delivered that rapid growth in our royalty portfolio. And that's been M&A. When we had the currency to do so back in 2021, we had a successful IPO, a very elevated valuation, not only on an absolute basis, but relative to our peers. And we used that to rapidly roll up 3 companies over the course of 2021 that added in very short order over 150 royalties into the portfolio. When our currency abandoned us, we started to focus on other pillars of growth. Namely, we started doing project financing. In other words, helping the construction and expansion of mines with producers and emerging producers that couldn't access capital otherwise. We did third-party royalty acquisition. For example, when prospectors were looking to monetize the royalties that they helped create through their staking and exploration efforts. And then we created another pillar of growth, royalty generation, where we stake exploration claims around existing mines and deposits, farm the properties out, and take royalties back in return. In other words, we're creating royalties through our sweat equity at zero cost to our shareholders. So you can imagine the rate of return proposition on those types of royalties could be infinite.
Okay, I'd like to revisit a few of those things eventually. At the moment, though, in terms of financing, in terms of juniors getting access to capital, you've described it in the past as kind of a nuclear winter. So is it still virtually impossible for a lot of the juniors to get financing? And if so, does that present a lot of opportunities for Gold Royalty?
Yeah, for the juniors, I mean, it's depressingly so. As you've described it, it has been a nuclear winter, and has been really since 2012 when gold reserves peaked out, and we've seen a decided lack of interest in the juniors, and as a result, we've seen a quite significant decline in global gold reserves. That's where you've seen so many of the producers cannibalize each other. Consolidation is the name of the game. If you're not finding it, you're going to have to acquire it. It has opened up prospects for the royalty and streaming companies to provide capital to the juniors to conduct their exploration development activities. Unfortunately, I would say most of the capital from royalty companies and streaming companies, unfortunately for the juniors, is focused more on the assets that are either near cash flowing or cash flowing currently and have expansion opportunities. In other words, I don't see a lot of appetite for the royalties and streaming companies to take early stage exploration risk on. And so, and I would say what we've done is really, similar to that, in that we focus on creating our own royalties and early stage exploration opportunities ourselves through our sweat equity, rather than putting scarce capital to work on early stage opportunities. So I'd say right now they're going to struggle in terms of early stage grassroots exploration for the foreseeable future. It's going to be the ones that have later stage development opportunities that are going to attract capital from the royalty and streaming companies.
Let's stick with that, the sweat equity that you talk about. I believe you mentioned that more than 25 of Gold Royalty's assets are through that route, where you have a very experienced team staking land around existing mines, to the point where oftentimes Gold Royalty is onto a land package that your peers don't even know about necessarily. So can you sort of flesh out how the team goes about that?
Yeah, so we have boots on the ground both in Nevada and Quebec and Ontario to focus on doing the staking work that has been so successful for us. And in fact, over 70 of our royalties, about a third of the royalty portfolio that we have, was generated organically through our sweat equity by conducting that type of grassroots staking effort. And it's being done by people that have been in the area for well over 30 years, so understand the geology and understand the claim map like the back of their hand. And so when they see opportunistically claims dropped, where they see claims that are either inadvertently dropped or deliberately dropped, we do pounce in and then try to stake those claims. The staking costs are de minimis, the holding costs are de minimis, and we can be quite patient waiting for our neighbors to knock on the door and look to consolidate land within their exploration budgets. And that's allowed us to, again, create royalties quite systematically, 2 to 3 per quarter, through our staking efforts at really zero cost to our shareholders.
So as you mentioned, one of the pillars of growth for the company is M&A. Although, to my knowledge, I don't believe you've made an acquisition since 2022, and correct me if I'm wrong. But also, so is now's environment a little more conducive to M&A, or not quite? You're not quite there yet.
Well, I certainly, given that we've all bounced off 52-week lows, I do expect to see further consolidation among the royalty and streaming companies, and we have seen that. But we're not in a position really to participate in that, given our depressed valuation. We don't have the currency to do the kind of M&A we did back in 2021. We rolled up 3 companies in the course of 9 months, when we had a share price north of $5 per share and a multiple that was well superior to our shareholders or to our peer companies. So we have to be disciplined, and we have to focus on the other pillars of growth that continue to grow the portfolio out. So as a result, I would say that we're unlikely to participate in M&A in the short term, but we do have a tremendous re-rate opportunity, and that could afford us, with a more elevated currency, the opportunity to start to look at consolidation again in the medium term.
So still with the share price, help me understand and help our viewers understand why it is that you've got gold at elevated levels, and yet and all these positive trends and tailwinds that you have at Gold Royalty, but the markets just aren't rewarding the story. They're not appreciating it. Is that the newness of the company, or there's more education to be done? Why do you think that is?
Well, I think both of those factors are an issue, and we are ramping up our efforts in terms of the marketing systematically, start to diversify our shareholder base beyond just the retail investors that supported us in our IPO. And we think this is an opportune time to do that, because we're about to deliver and crystallize significant growth. And you alluded to it earlier on. We're looking at 360% growth in our revenue profile and our gold equivalent ounces over the course of the next 5 years, under any gold price scenario that you can imagine, because of the ramp ups of some very significant assets, particularly in the Americas. We have royalties on 3 of the 5 biggest producing gold mines in North America, namely Canadian Malartic, Côté, and the underground extension of Goldstrike, all of which are ramping up into significant production, and we have significant royalty coverage in all of those. As we crystallize that growth, we're likely to achieve a significant re-rate in our valuation. By consensus estimates, we're trading at about 0.5 times our net asset value, P to NAV, as the analysts like to refer to value these companies. And I think the reason we've been discounted so severely is, with all that growth, there's the perception that there's execution risk. But I think it's important to understand that the majority of that growth is coming from those large-scale assets that are undergoing ramp-ups and expansions, but with some of the best capitalized and most significant operators in the world, namely Agnico Eagle, Barrick, Newmont, IAMGOLD, all of which are well-capitalized and also have the technical capacity to advance and optimize these assets. And that will deliver the growth that we're looking at over the course of the next 5 years. And I would add that's peer-leading growth. And that growth across the sector is not unique to us. Anything that has growth tends to get discounted until that growth is de-risked. And I would hasten to add that growth has been substantially de-risked. The construction is complete. It really is ramp-up phase on those large-scale assets that I mentioned earlier on.
You mentioned that Agnico, you had a long run there, of course, during your 35-year career in mining. You were at Goldcorp, Hudbay, at very high levels within those companies. So a lot of experience. And I'm just wondering, how do you apply that experience in assessing projects and developing mines, combined with what presumably is an extensive network of contacts in the industry, and then you add on the experienced team that you have as well. So put that all together as far as letting investors know how it is that Gold Royalty and why Gold Royalty has a competitive advantage to peers.
Yeah, if you look at our experience on an aggregate basis, there's over 400 years of industry experience within a very small board of management team. Collectively, our board of management are really a little bit more than a dozen people. And so you can imagine that concentration of expertise is unique to our story and unique among the royalty and streaming companies in the space. We're not populated by financial engineers. We're populated by people that have actually built and operated mines. And so I'm not unique in that regard. When you look around our boardroom table and within our management suite, we bring a lot of operating and mine development expertise, which gives us a couple of distinct advantages. One, it gives us a clear-eyed view of the underlying risk of what we're investing in. We've been in the boots of the operators and developers, so we can assess that risk quite capably. But also, as you correctly pointed out, it gives us access. And that means we've been able to pick up the phone and talk to virtually anybody in the industry about opportunities to populate our portfolio, which now stands at over 240 royalties. I would say the reason we've grown so rapidly over 4 years from 18 royalties over 240 royalties is because we've leveraged the network that each of our individual board and management bring to the table to access opportunities before many of our peers are aware of them. That's why we've not only grown out the portfolio in terms of scale and number of royalties, but also the quality of the portfolio, with a heavy concentration and some of the best operating assets in North America, but also within some of the best jurisdictions, with over 80% of our royalty portfolio in Nevada, Quebec, and Ontario.
All right, so you've been giving us a sort of a longer form version of the investment case for Gold Royalty. What's the 45-second pitch that you give to people on a regular basis?
Well, this is a pivotal year for us. We're going from startup to free cash flow generation. Last year was our first year of positive operating cash flow. And again, that's from a standing start 4 years ago when we had zero revenue and 18 development stage royalties, to one where we're generating positive free cash flow this year for the first time in our history. And given the scalability of our business, our cost structure is fixed. We have uniquely royalties. We don't have any streams within the portfolio on the gold side. So that means we have no elevated costs as our production goes up. Every incremental dollar of revenue growth falls right to the bottom line. And if you look at our revenue growth at any conceivable gold price scenario, we were looking at potentially $80 to $100 million of revenue from the existing portfolio that's completely bought and paid for against about $7 to $8 million of corporate costs. That's tremendous free cash flow generation. And if you apply any reasonable multiple to that, that means our share price should appreciate 8 to 10-fold based on any reasonable peer multiple.
Okay, we have a couple of questions here, David, from viewers. We'll start with Thomas Halla. He's asking, what are the possibilities about Gold Royalty becoming an acquisition target itself by a major royalty company? Is that something? Obviously, you have a duty to your shareholders. Is that something you'd see coming down the line?
Well, as I said earlier on, consolidation is inevitable in our sector among the royalty and streaming companies, because what's absent is a mid-tier champion. We have the category killers in Franco, Wheaton, and Royal Gold that are immense companies. And when we have a collection of other smaller scale companies that are sub $5 billion in market cap, what's missing is that $5 to $10 billion market cap Goldilocks company that's big enough to be institutionally relevant, but still small enough to grow, because arguably the big guys really are X growth. They're getting growth multiples, but they can't conceivably growth given their absolute scale. If we can create that mid-tier champion through consolidation, and believe me, every one of the CEOs among the smaller cap or royalty companies recognize the value proposition of doing that, creating that, again, that mid-tier Goldilocks type company. The potential is it could get a multiple superior to what the seniors are getting, because they offer the liquidity and scale that institutional investors are looking for, but importantly, add growth and offer growth where the seniors simply can't do that.
And would you say you want Gold Royalty to be that company, to be the Goldilocks mid-tier royalty firm?
Well, that's always been our driving corporate vision. Would have liked to get there a lot sooner than we have, but we've had to be disciplined. As I said, we had the currency in 2021, and we aggressively rolled up and expanded the portfolio over the course of 2021 when we had the currency to do so. But our growth since then has been quite a bit more deliberate. We focus on individual assets, again, leveraging relationships in order to get acquisitions into the portfolio on an accretive basis without having to compete against our peer companies. And that's the way we'll continue to grow until we recapture our multiple, and then we'll look to aggressively grow through M&A again. But right now, we're going to have to be much more deliberate and wait for that growth that we've promised our shareholders to be crystallized. And we're in the midst of doing that. And we think the re-rate is imminent and going to be immense.
All right, David, a question from Brad Condiker. Now, my mother always told me it's not polite to ask about money, but you do run a public company, so I guess it's fair. Brad is asking, what is your salary, and how does that compare to the salary of your peers?
Yeah, so again, $7 to $8 million is what our corporate G&A costs are well in line with our peers in terms of overall costs. In terms of our compensation across the executive seat, we compare ourselves to our peers. That's well published within our management information circular, and I'd urge you to read it. But we're within the median of compensation among our peers within the small cap universe.
Lastly here, David, is there any topic or point that maybe we didn't touch on that you'd like to bring up, either from a macro perspective on gold or something about the company?
Well, look, I think that we still have quite a bit of runway on gold for all the reasons I mentioned earlier on. I think the best leverage proposition is among the streaming and royalty companies that offer that scalability, unmitigated leverage to the gold price and to the exploration success of our underlying operators without having to worry about cost inflation. We're really top-line exposed, which is an important part of the model. And given our stable cost structure, that growth in revenue, whether it's through the gold price or through growth in volume of production attributable to our royalties, falls right to the bottom line. But on top of that, as I mentioned, leverage to exploration. Our operating partners invest over $200 million per annum on exploration within their portfolios. That's equivalent to over 500,000 meters of exploration drilling per annum. That's immense exploration upside that we contribute nothing to. We get the full benefit of the exploration of our underlying operators because all of our royalties are completely bought and paid for. We have no installments. We have no capital calls. All that growth that we've talked about, that 360% growth, and our gold equivalent ounces over the next 5 years is really coming at no incremental cost to us or to our shareholders. We're just waiting to collect checks effectively.
David, we've gone just about 25 minutes here, and I think that's a Goldilocks show. Not too long, not too short. Perfect for a commute for somebody to listen to or watch on the replay. So we really thank you for taking time out of your day for us today. Always great to talk to you.
Thanks, Mark.
Okay, David Garofalo, how good was that? Chairman, CEO, and president at Gold Royalty. We got a little bit on the broad picture as to the drivers for gold, and he dug down into Gold Royalty and its prospects as well. Thanks for those questions. We appreciate it. We'll do this again soon, and we'll talk to you again. Take care. Bye-bye.